let's get it started. We're all here and happy to have Harald Uhlig talk to us about an amazing topic. It's hard to get through, I have to say. Money markets, collateral, and monetary policies. Short, yeah, different titles.
Hopefully that's the right title.
Anyway, from the University of Chicago, PhD Minnesota. Yeah, I just looked through a gigantic 2-volume book. What's 2 volumes? We wrote together called The Handbook of Macroeconomics, 2016. Not that long ago. We'll have to do another one. Okay. Howard, welcome. You're really welcome. Many times over. So thank you for being here.
Yeah, no, thanks for having me visit Hoover. It's actually, we're having a great time here. And so thanks for all the support and thanks to the 2 drawings. I mean, we wrote a paper together in 1990 already, so that's a long time ago. So thanks for being here. So this is a joint work with Fiorella de Fiore, who is at the Bank for International Settlement, Marie Hoerova, who is at the European Central Bank, does this work, and Ciaran Rogers, who used to be a PhD student here, and now it's at HEC Paris, and then me, and paper has been a long time in the making. We were interested in thinking about the Eurozone crisis. That was the original motivating factor. And when you think about the Eurozone crisis, you know, the interbank market was in, let's say, upheaval. There was a word there that said it can be impaired, but I don't know what that means, but that's the word that central bank documents would say. So when you look at the Eurozone crisis from 2010 to 2015, a bunch of things happened, but in particular, as far as the interbank market were concerned, the share of unsecured interbank borrowing declined throughout European Monetary Union. The bank borrowing from the European Central Bank in the south increased 8-fold. The market haircuts on southern government bonds increased substantially. Nonetheless, the household deposits at banks remain stable. There's a bit of a U-shaped pattern to that, and I'm going to talk about it, but they remain pretty much stable. And these so all these things have affected the interbank money markets, and these interbank money markets are important, and they're important for liquidity management. It's something that central bankers certainly worry about a lot. And so central banks now have developed all these additional tools to try to deal with that. Often we write down, you know, I don't know, 3-equation Keynesian model. There's normal interest rate, it's set according to the Taylor rule or some other principle. But central banks do a lot more than that. And actually they worry about financial markets a lot. So here we want to go beyond the question of how to set interest rates in terms of inflation and so forth, output gaps and quantitative easing. We want to think about how does the central bank interact with that and what are the macro impacts. So what we do is we construct a quantitative general equilibrium model to understand this. And what we're going to have heterogeneous banks, because we have this north-south distinction. We have this distinction between banks that can borrow unsecured and unsecured. So there's a lot of heterogeneity across banks here. We're going to have one central bank that may lend against collateral. And when it does so, it imposes a haircut. So these private sector and central bank sector haircuts play a crucial role here. And then in the end, we want to compare, I mean, you know, we had a bunch of policies to compare, but in the end, we settled on 2. So we compared the benchmark policy to an alternative policy. So what's a benchmark policy? The benchmark policy is what the ECB has done, namely lend against bonds at a favorable haircut. So they didn't impose the draconian haircuts that private market did. They had light haircuts. I mean, you could think maybe that's a bad idea or a good idea. We don't have anything to say on that. That's what they did. And we compare that to an alternative where the bank actually doesn't lend at all. I mean, you can't go to the central bank and borrow from there. You have to get reserves if you need them
on the private market. Badgett rule?
Pardon?
Badgett, that's from Walter Badgett.
Yeah, I mean, so the
they should lend at a penalty rate.
Right, they should lend against good collateral at penalty rate. So there's also there is an emergency lending program that the ECB has and has been used in Greece. Technically, it's actually done by the national central bank. So it was the Central Bank of Greece that did it. I mean, it played a role during the Greek sovereign debt crisis, but overall not so much. So lots of banks, yeah, I mean, you could say it's an implementation of the Bartlett principle, if you like. Yeah.
That's how it's seen.
It wasn't like a constant policy in this period. There was a bunch of innovations.
Right.
One was for the banks, the ECB said, hey, we will take all sorts of stuff as collateral that previously we wouldn't take at all.
Right.
So for example, this move from banks, from interbank market to ECB market, well, the ECB says, come and get the money and you can post whatever junk as collateral you want and we'll give you a great haircut for it. Well, surprise, surprise that they went and did that.
Right.
Similarly, there was, other things like Mario Draghi said, whatever it takes in there.
Right. No, I mean, there's a ton of things going on, and we thought about them. They came up. As you're going to, the model in some ways. I mean, I don't know. Is it simple? Is it complicated? Anyways, the model that we have has, that's going to be my defense. Has already 91 equations, and it took us, actually more time than I care to remember to cut through those. And so whenever you're going to say, well, why don't you have that feature in the model? I'm going to point at that line and say, look at it. So
You have a parsimonious 91 equation.
exactly, it's as parsimonious as you could write it down in essence. So the policies differ concerning the rise of the private sector haircuts. That's really where these two policies have a difference. And the fallen output, the initial fallen output would have been twice as high under the alternative rather than on the benchmark. So that's going to be what we're going to show. So here's a picture of that. I'm going to explain the lines here, but the yellow line is when the private sector haircuts started dramatically rising, and when the banks would approach the central bank to borrow from there, and you can see this benchmark policy in red, in blue, and the red policy is the alternative. Now, interestingly enough, there's a rebound that's later, right? And so you could say there was a bigger whipsaw, would have been a bigger whipsaw under the alternative policy. Okay, so let me get into this. There's lots of literature. So here's my literature review. We really only mainly rely on two papers. One is, what's a theory of bank leverage. Here we rely on Gertler, Karadi, Kiyotaki. So they have a model where you can maybe run away with a share of the assets, and that imposes a leverage constraint. That's become very popular, and so we use that. But then we also needed a reason for liquidity management, and there's a nice paper by Bianchi on econometric in 2022 that we built on. So essentially, we're combining these two into one model. Okay, so let me first show you some data. Here's where the data comes from. Not that interesting, but we distinguish between two regions. North for us is Germany and France, and south is Italy, Spain, and Portugal. Now you could ask, why not also Greece? Why not, other countries? But that had to do with the limitations of the data that we had. So, anyways, so let me show you. So here's a first observation that we saw this decline in the unsecured shares. So you see the solid line represents the unsecured borrowing, where banks just borrow from each other without having to post collateral, and you see the decline both in the north and the south. So that's a symmetric movement with the secured borrowing rising. Now here it's so this is, you first used to have only this slide that just shows the shares, but in contrast to the United States, the interbank market in Europe is alive and well. It's just that now you have to post collateral to borrow. I mean, in the US, that interbank market has largely collapsed because they're all borrowing now from the Fed.
The unsecured amount rise, or?
Yeah, the secured amount rises, right? It's substituting for the unsecured. The overall amount.
The overall amount is unsecured. What's the unsecured levels doing?
Well, so the secured rises some and the unsecured falls. So there's a substitution. I don't know what the total is, and if that's the question. Yeah.
Dramatically,
yeah. I think the share was initially 50-50. So
all borrowing from the ECB is secured.
Yeah, so that's not part of this here. That's the interbank market. Yes, right. Yes,
Interbank is unsecured.
yes, can be unsecured, some of it.
Okay, so some of this is a choice to go to the ECB. And some of it is
Exactly.
a choice in the interbank market to start asking for collateral.
Right. So we're getting into a portfolio problem here right away, right? Because a bank can, some banks can borrow unsecured. Some banks, if they borrow secured, they have to post collateral, and then they can decide, do I go to the ECB, where I have to post collateral there, or do I go in the interbank market? So there are these portfolio trade-offs that are inherent to what we do.
It's just a wholesale funding, right? Like, is it like money market?
Yeah. That's yes.
US, they borrow from the agencies and pension funds.
Right. Yeah. It's, I think in the United States, at least federal funds make it, right? I mean, it kind of disappeared. It's just foreign banks and home loan agency, essentially.
Can I ask you, Harald, about
Part of
market
it's
structure?
Go ahead.
Thank you. In practice, so this is an interloan. This is a market crossed by markets for just banks in EU countries
Yeah,
and in euro-denominated
right.
assets, or
right.
can a bank from a non-EU country? I was thinking about, is there any currency considerations if the market access?
Yeah, so I'm pretty sure this is the interbank market of banks, borrowing, lending in euro within Europe, right? I mean, and borrowing, lending,
But like
ECB
Norway,
reserves to each
Like
other.
a country that is physical in Europe, but does not have the euro, would have a bank that can participate in this market.
Well, it's not here, we don't measure it, right? Because
Okay.
there's more, these 5 countries. It's a good question whether they have access to the ECB balance sheet. I mean, probably some of them do, but I don't
How
know.
much does it matter if you only have these 5 countries?
Well, it's these are the 5 large countries, so the other ones are all smaller. So I think it's a pretty,
Same picture?
well, we don't have the data for all the other countries, so there's a data limitation.
Okay.
So Harold, one thing that was going on in the middle of this period was the Fed had swap lines
Yeah.
for the other central banks, the ECB, et cetera. What role does that play, and what's helping to facilitate, if any?
Yeah, so the only thing that we consider here is collateralized borrowing from the central bank. And there are many more instruments. So
Rob,
91
what I'm
equations.
concerned about is, were they more willing to do this because of the swap lines of the Fed?
Yeah. It would be interesting to compare, it's not a comparison to the United States, right? It's specific to Europe here.
Yeah,
It's
given they have the
right.
support from the Fed, I'm just wondering.
The central banks introduced sort of a whole plethora of instruments, right? And announcements and what have you. And this is only, focusing on one part. Okay, so observation 2. So that's the solid line. The borrowing from the ECB didn't change much in the north, right? It stayed pretty flat, but increased 8-fold in the south. And so there's a clear distinction here between northern banks and southern banks. Now, the same picture also says,
Just a question. Is it the distinction between the banks or the assets they have to pledge?
it's going to be, well, in the model, we're going to say it's the same, right? And just hardwired to be the same.
Because presumably all of the lending that they're doing and all of the borrowing they're doing in the secured market, the southern banks, where they're doing it in the private market, they're posting collateral, which is bonds and, and other high quality bonds. And it's because they have a lot of the low quality bonds that
Exactly.
they have a huge haircut. That's what they're taking here.
No, exactly. So it's a really strange feature. There's a strong home country bias in terms of the bonds that banks hold. So Spanish banks overwhelmingly hold Spanish bonds, German banks overwhelmingly hold German bonds. It's really weird. It should be the opposite, right? Spanish banks should hold German bonds and the other way around in order to unfreeze yourself from being tied to the fate of the sovereigns.
It's not a surprise. It's not an irrational behavioral bias.
Yeah, so here we hardwire it.
Hold your own country bonds, your regulators say, oh, Luigi, you're not at the bond auction. Should we come look at your books?
Could be financial repression. I have another explanation in another paper that I'm happy to talk about it, which has to do with the if a German bank holds Spanish bonds and Spain goes under, right, then in principle the fiscal authority in Germany has to kind of back the German bank, and the ECB is made whole. But if the Spanish bank sold Spanish bonds and Spain goes under and the bank goes under, the ECB is stuck with the loss. So I wrote this up as a working paper when I was an ECB visitor, and I had the paper on American methods, and they said I can issue an American methods working paper. You can't issue that one as an ECB working paper. So I don't know whether that's the right explanation.
This is fairly simple. So everybody wanted to get rid of Greek, Italian bonds, especially French and German banks wanted to dump them.
Right.
The ECB wanted to prop up this market. There's a limit to how much it was going to buy directly on its own balance sheet. So it simply told the Italian, Greek, Spanish, we don't have Greece here, but they told the Southern banks, look, you guys buy this stuff up, we'll lend you the money to do it, and you can post the stuff as collateral.
Right.
It's kind of an indirect way for the ECB to buy up all its debt.
That's essentially, if you like, the story, right? I mean, so here they keep the haircut favorable in contrast to private markets. That's our benchmark.
That's like an arbitrage for banks.
Well, not quite, right? Because they're getting the bond back, right? I mean, they're not selling the bond directly. Just so
the sense of arbitrage is there was no capital charge. So there's never been a capital charge on sovereign debt in European, which is just scandalous.
No,
As long as default doesn't happen,
right?
Yeah, it's an arbitrage except for default, but if there's no capital charge, no limit to this whatsoever.
Right. No, I mean, there are all kinds of sovereign default implications.
Sorry?
If the Eurozone collapses, you have to.
Oh, yeah.
You have to target two balances that have to.
The Germans will come to the rescue.
Yeah, so that's another huge topic. So I'm going to leave that away. So this is just sort of taking the segment. This is the same picture because there's also a dotted line here, and these are the haircuts, and you can see, sort of in line with the discussion that the haircuts practically for northern bonds didn't change, whereas the haircuts for southern bonds changed dramatically. I mean, they went up a lot, and so that explains the borrowing from the ECB that offers favorable haircuts. And then finally, I mean, here's also the borrowing from the ECB, but you can also see the borrowing from the households or the deposits as a share of the assets. And what you can see, I'd like to emphasize that it remained fairly stable, but you can also see, sort of a dip there that moves in the opposite direction from the borrowing from the ECB. And so we're going to have that dip also in the quantitative implication. So we like to emphasize that too.
Do you think of it as a substitution?
Yeah, it's substitution effect that the banks went, borrowed from the ECB rather than from depositors, and then eventually went back and borrowed from depositors rather than the ECB. That there was a.
Do you have an account for why deposits were so stable in this period of time? Because there's at a first order, it's not rational if you're a household, if you're to keep your deposit in an Italian bank. It seems like. Upside downside. I'm just wondering. I think that has been a striking feature of the Eurozone experience, but I wonder if you have a theory of that.
Right. So in the model, we kind of hardwire it because, as you're going to see, households don't have much of a choice of assets, so they can hold deposits or money, so they're stuck. But I think the answer may just be in the deposit insurance scheme that Europe has embraced. And there was this moment during the 2008 financial crisis that I vividly remember. There was sort of an interbank bank, that was ready to collapse, and in Germany, and there was talk among the finance ministers at a conference to issue, blanket deposit insurance, and Germany said no, that's up to the banks to do it. We don't do this. I think this was November 2008, if I remember right, during the financial crisis, and then the bank collapsed, and then the German government, Merkel, issued this statement: "Your deposits are safe," and was publicized in widely circulating newspaper, the Bild Zeitung and so forth. And it's not clear what that really meant. It didn't say we guarantee your deposits, but I think everybody understood that this was an implicit bailout guarantee by the government. And then very quickly after she issued that statement, money flew into Germany like crazy from all the neighboring countries. So all the other countries then had to follow suit and also issue these implicit deposit guarantees. And so my guess is it's these deposit guarantees by
Although
fiscal authorities.
the second part of your story deepens the mystery, because why wouldn't that continue? Because the promise from the Italian government is not of the same credibility as the German government.
Maybe, yeah. No, I mean, fair enough, right? I mean,
Just to understand, in Europe, it's very unless you are very large investors for an Italian household to purchase to perform these operations. There's free mobility of individuals, but not of capital among EU countries. So.
But corporations could do. I mean, presumably.
This is the household. No, it's borrowing from the private household.
Yeah, the deposits here is borrowed from the household. Yeah, I mean, deposit guarantees are private. There's the federal guarantees in Europe are implicit, at least in Germany, and so it's also they are different from the United States. Okay, so let me show you the model. It's a general equilibrium model with really two key features. So we have this Gödler-Kawadi-Kiyotaki leverage constraint, and we have the Bianchi-Biggio liquidity feature. So let me talk it through. So discrete periods in the morning, the households choose between deposits and money, right? So that partly answered that question. And they choose how much to work and how much to consume. And production takes place. Production is kind of boring here. Foreigners choose bond. We need that somebody else rather than just banks sold and central banks sold bonds. Households don't do it, so we have foreigners having elastic bond demand. And then what do the banks do? Well, they collect returns on the assets. They pay dividends as a fraction of the net worth. They're just hardwired. They get randomly assigned at the beginning of the period to north or south. I mean, that's ideally would just like banks always be northern banks or always southern banks, but that introduced additional state variables, and so we just did it like that. So every period. The Deutsche Bank doesn't know whether it wakes up being a Spanish bank or a German bank. That's a feature of the model. And then it can be connected or unconnected. I mean, that's what connected means. You can borrow without having to post collateral from other banks. Unconnected means you cannot. We had in mind some kind of network theory, and that was a remainder of that. So we don't say why you have to post collateral. We just hardwire that some banks can, some banks cannot. So then they have to make a portfolio choice. They have to they invest in capital, but they also can hold reserves, which they may need. They can invest in bonds. There are two different bonds, right, with the different haircuts, and they can borrow from the central banks, and they also issue deposits. Okay, so there's a Gödler Kawadi-Kiyotaki collateral constraint. And there's also constraint vis-a-vis the central bank. I think there should be common there. Anyways, and then in the afternoon, they're government bonds, right? They're only government bonds and no private bonds. So they're private.
How does the capital?
So the banks own the capital stock.
Oh, okay.
Yeah.
There is
So
a separate corporate bond. Okay, good.
Yeah. So they own the capital producing firms, and they sell, and so the banks hold the capital stock here, right? Yeah, sorry. Yeah, so the only bonds that are here are these government bonds. And in the afternoon, that's the trick by Bianchi-Biggio. There are these random withdrawal of deposits. I mean, people make payments. But of course, when I make a payment to Bob and I send money, my bank account goes down, but his bank account goes up. So it's really reshuffling between the banks. And so that means there are some banks that are now flush in reserves and other banks that are not, and the ones that are not may have to borrow from the ones that are flush. Some, if you're connected, you can borrow unsecured, but if you're unconnected, then you have to, if you borrow in these private markets, you have to borrow against your government bonds, and they're subject to a country-specific haircut. So J denotes here the country or the region, could be north or south. But you can also use reserves. If you have reserves, you can just use those to meet these withdrawals. So you're going to see how that works. And at the end of the afternoon, all these flows of payments are reversed. So Bob repays me at the end of the afternoon, and the banks go out with the same portfolio that they had at the beginning of the afternoon. So this is just really as a way of, modeling the liquidity need of banks.
Do I redeposit in the same bank where I took it out?
Yeah, so the banks end up with the same amount of deposits.
What's the bank's problem during the day?
Well, they have to meet these withdrawals, right? So they're, I come to my bank and I want 1,000 euros. So the bank has to produce.
Cash out during the day.
Yeah, that's right. That's right. I take cash out of my cash machine. The bank has to meet that cash withdrawal. I go to Bob and give him, he deposits 1,000 euros. So his bank has an additional 1,000 euros. When there's a bit of, if you think hard about it, there's something odd about the timing here, right? Because by the time my bank needs to borrow the 1,000 euro, maybe Bob hasn't deposited 1,000 euros. So we ignore that. I mean, essentially.
That's the morning afternoon.
Yeah, that's in the afternoon, right? That's all happening in the
No
afternoon.
Herstatt risk.
Pardon?
No Herstatt risk. Herstatt risk is the timing.
Yeah, right, exactly. Yeah,
bank.
so we have to acknowledge this. Mhm.
Out here, whether you're connected or unconnected is random, it's exogenous.
It's
but
totally
I
exogenous,
guess
yeah.
in reality, whether you can borrow secured or unsecured, there could be a lot of adverse selection there, right?
Absolutely, yeah, absolutely, right.
It's a-
91 equations is my,
Just
True.
worrying about these liquidity risks. I thought the whole problem here was solvency of the government bonds. That
yeah,
I
so,
don't see
right.
paying taxes and paying coupons on these bonds in the model.
Yeah, so we don't have, we didn't model the sovereign default risk either, right? I mean, you could conceptually embed it in the sovereign default model, and
But wasn't that, I thought fear of sovereign default was like the central issue of this whole episode.
yeah, so we're going to have private sector haircut rising for reasons. I mean, they're just going to be exogenous in the model. Of course, the reason that they're rising is because of sovereign default fears, which we don't explicitly model. We just have the haircuts. I mean, that would be, again.
Okay, no, so, but I'm getting pictures.
Yeah.
The picture is you want to see how does the sovereign thing spill into the real economy and the banking sector and its ability to make real loans.
Yeah.
So
Right,
just model
exactly.
The haircut going up. Now I've got less ability to borrow in order to make these cash needs, and now so it's not really about the sovereign default.
Right. Yes, exactly. It's
How
repercussion.
that
Right.
hits the real economy.
Okay,
Exactly.
good.
While nobody defaults, right? And of course, if a country defaults, then I don't know, you're often another branch here in this model. Okay, so here's another graphical way of showing that, right? So there's a central bank, and there's this whole banking system, right? They're connected north, unconnected north, connected south, unconnected south. The southern banks only hold southern bonds, the northern banks only hold northern bonds. So that's hardwired. The central bank can provide, can get collateral, can fund these banks against collateral, right? So it's collateralized funding. The households deposit. And so the central bank issues M0 in two ways, right? It issues money to households as well as funding, reserve funding to the banks. The banks fund firms, holding their capital, and there are these governments that issue bonds, northern bonds and southern bonds, subject to different haircuts and therefore different prices, and the foreigners also buy them. And then you have the dotted line. There's the afternoon. There's beginning of, two parts really. So households start withdrawing, and they deposit, right? And it all, you think of that as simultaneous. And so there will be liquidity rich banks at the bottom and liquidity poor banks at the top. And maybe the liquidity poor banks have to now borrow. If they're unsecured, if they're connected, that's great. They can borrow unsecured. They just call up their friends and say, please, I need $1 million, and they send it over. But only for the other ones, they have to post collateral. Okay, so now there's a lot of stuff going on, and keeping track, understanding the impulse responses, and so forth.
And what is
was a bit of a
the
nightmare.
household's problem? So they receive profits from the bank.
They-
What do they save in? I'm thinking about the household problem.
Yeah, they also maximize utility subject to their budget
But
constraints.
they no labor, but I wonder how the firm's profits are rebated back to the household.
So the firms are in perfect competition.
Yeah.
and it's just pricing,
Ah, okay.
right? I mean, they're just price capital, they price
Okay.
wages. There's an adjustment cost. I mean,
Okay, yeah, no,
you know,
yeah, yeah.
I mean, there's a technology to transform old capital to new capital.
But
and
just,
adjustment
so what do they save in households?
they use deposits and money,
Okay.
so they can't hold bonds directly.
Okay.
Yeah,
Okay.
yeah. So there's so these models already have a bunch of features that show up in the impulse responses, but there are a few that are think of new here. It's, you know, there are four main forces or four main effects. One is this capital crowding out effect. If you have to post more collateral, that means you have to can invest less in capital, and that will dampen investment output. There's a bond and reserve substitution effect. So banks have to solve this portfolio, the unconnected banks. Should you hold more bonds or should you hold more reserves, right? You can get reserves directly. There's a total amount of reserves, and maybe as haircuts rise, maybe you want to hold reserves rather than bonds because bonds are no longer as attractive to meet your liquidity needs in the afternoon. There's a north-south liquidity spillover effect. As the southern banks shift into reserves, this affects the collateral premium and collateral value, even for northern banks. So even though the haircut is going to rise in the south, the northern banks are affected because of this pecuniary spillover. And then finally, since the central bank offers a different haircut than the private sector, then, you know, that, I mean, as John mentioned, right, that makes banks move into private market, into funding from the central bank. Pardon?
Happening to the interest rate on reserves?
So the interest rate on, so we have an interest rate on central bank funding that we keep constant. So the interest rate is kept constant here. There are all kinds of interest rates floating around, right? The households, you know, they don't borrow directly from the central bank, they have deposits. So something happens with the interest rate here. We don't have sticky prices in there, so there's an entirely Fiorian model, so inflation.
North-south liquidity spillover effect.
Yeah.
Arises, as I understand it, from the difference in the interest rate on bonds and reserves getting affected by the reserve scarcity originating in southern banks. Is that right?
Yeah, so the southern banks suddenly need they need more, you know, reserves or more collateral, but the northern unsecured also need the collateral, and so they're competing for the same source of collateral, and that makes the collateral more expensive for the northern banks. And as a result, they're also, even though the haircut only rises in the south, that's what we're going to assume, the northern banks are affected because they're competing for the same pool of collateral, be it reserves or be it yeah, I mean, really just
So
money.
the interest rate's not a sufficient measure of credit.
Exactly, yeah. So
Basically, it's all going in the price of cloud.
yeah, right, yeah, exactly, right. So the whole question of what interest rates do, I mean, the interest rates on the bonds change, interest rates on deposit change, but we on purpose kept the interest rate on central bank funding constant. I mean, that's just, I don't know what we assumed, I think 1%, 2% or something. Yeah, because that's not, you know, exactly, that's not where the action could be, but we just shut that one down. So then here's a model. I don't know how much should I say about this, maybe not much.
Hey, that's the model.
That's the model, right? Okay. That's actually should be the shortest slide. So let me go through this here. That's fine. So there's a household maximizing utility. So you sum this over an infinite horizon, of course, and they can hold deposits at a risk-free deposit rate, and they can hold cash, and they have money in utility function there. They are firms, you find good firms that produce output using capital and labor. They're capital producing firms, they transform old capital in new capital, and the capital is held by banks. So banks are always the holders of capital. Fiscal policy are entirely mechanical, and you could think of the two regions, but it's a representative household. So we didn't have we don't have Italians and Germans in the system, in the model. We only have Europeans, and they get they get taxed at the same rate. So really, ultimately, what only matters is essentially the consolidated government budget constraint. That's the second line there. And you can think of, you know, implicitly transfers between the north and the south going on that are, could be of interest, but you're not that interested. So Yeah, so there's a tax rate on labor income. They issue these bonds, and then they have a fiscal rule that's there on the debt chain. So if you're far away from where you want to be in terms of your debt position, then you just reduce the debt and you just raise taxes, so that's going to happen.
You know, the household problem because of the substitution effect that you were hinting in the graph. And then if I think about the European Union, I think about the taxation regimes that's being country specific, but the transfers as equalizing.
Say this again.
Sorry. I was fixated on the household problem because of the graph you showed us.
Right. Yeah.
Substitutory borrowing. And then I was thinking, so it matters how I save, so it matters how much I gain by, labor income wise. And I thought about the U, as a picture.
Right.
As a collection of country-specific taxation regimes, but with an authority that fiscally transfer and tries to equalize consumption exposed via transfers. So if you had asked me, I would have expected the tau to be country-specific, but the capital T to do a lot of the ex-post adjustment, so to speak. Does it matter? The tau is common across countries.
The households are common.
Tau.
Tau. Yeah, it probably does. Again, that was not
At all.
Another can of worms that we wanted to open, right? So it's a European household, European capital market, right? Again, you could think that you're investment in the south rather than investment in the north. It's common capital market, common household, common tax rate. So all of that is common.
And the conjecture was, but it affects your savings. So the labor income tax affects your saving effectively, and so your ability to absorb your ability to save must have an impact on the ability of banks to borrow.
Well, there's a European market for deposits, right? And so again, it doesn't matter to the household whether you deposit at a Spanish bank or German bank, and there's a supply of deposits coming from the household. Depending on the interest rate, there's demand for deposits coming from the banking system, right? And they have to sum up. So there's a market clearing condition.
Okay.
I don't know why that answers this.
I call this a new Keynesian model. It looks like it's entirely real.
Yeah. And it's not the new Keynesian model. Sorry, maybe I mumbled this, right?
No, you said it. That's what you said.
It's
flexible price
it's
model.
totally flexible price, and thanks to your blogs, I'm more convinced than ever that we don't know really what drives inflation. So here we just have a Fischeran economy, which means that nominal rates and inflation move in lockstep. And so so this model, on the face of it, will have strange implications for inflation, but that's not what this model is about. Yeah. Okay. Here's the central bank. It can hold northern bonds. It can hold southern bonds. It can issue these loans to banks, and they are one period. They're one period loans. So this is really just a collateral on the asset side. These are just the collaterals that they hold against these loans. And then liabilities are reserves plus currency in circulation. And then there's finally bank equity. So the collateralized loans, they have to be, there's a haircut. So A.T is, so let's A.T is 0.97. That means for 100 euros posted, you get a loan of 97 euros. Normally the haircut is described as 1 minus A.T. In fact, the A.T, the A.T is kept constant. Sorry, there should be no T on there, and that's regardless of region. And that's that's a benefit to the southern bonds in particular.
No, given our remark that this is a real model, why do you bother with having all these nominal variables?
Yeah, because prices do move, and the bonds are nominally safe bonds. So we,
that's an important feature of the model.
Well,
you could reduce 91 to some smaller number by.
Prices do move, and therefore I don't know. You can look at interest rates.
Well, that's why there's a difference.
Right.
Nominal
we could have in the end divided everything by P. That's fair, but we felt more comfortable writing it down nominal because the bonds have nominally fixed payouts. In fact, we have bonds of in the paper. Our bonds have a 6 year maturity. So then there's all kinds of dynamics as a result of that. But I agree. I mean, conceptually, you could probably write it at least at this level down in real terms.
I'm on your side of it. 91 a smaller number.
Yeah. So and now the banks. So they get this shock, this IID connectedness shock or network shock, new whether they can borrow secured or unsecured, and they get this IID shock whether they are holders of northern or southern bonds. Maybe that's really the right way of thinking about it. And then given that they learn this in the morning, they pay their dividends, they get the shock, and the dividends are hardwired here, right? Banks would always like to keep net worth inside the bank, but we force them to pay dividends. And then they make the portfolio choice, capital, bonds of the particular region they're in, and it depends on the network type, whether they want to hold any, how much reserves, money do they hold? We call reserves money here, same thing. And then liabilities, deposits and loans. So it's a portfolio problem that, you know, took us time to think through, and I'm not gonna bother you with all the details of that unless you really want to know. Okay, and then the afternoon, there's a liquidity management, there's a liquidity shocks that realizes some omega that's smaller or equal than some max omega, and you just have to make good on these payments. So we assume that banks they're not allowed to go bankrupt here. So they know this might be coming, and they have to make sure that they can get enough money or reserves to pay, demanding depositors in this case. So here's a bank balance sheet. That's a bank balance sheet. They hold capital, they hold bonds of the country, they have to pay dividends, they hold reserves. And there's liabilities, they have deposits, they have the central bank loans, and they have their own net worth. The central bank loans are collateralized, so that's the EDA. The EDA there is the central bank haircut parameter, or 1 minus EDA is the haircut imposed by the central bank, regardless of region. And then in the afternoon, so there's a leverage constraint here. Sorry, there's some. Okay, so the bottom is the Giordano-Kiyotaki leverage constraint. That essentially says that how large a balance sheet can be relates to the franchise value of a bank, right? So, you can run away. I mean, that's the idea. You can run away with a lumped share of your assets. So these are your bonds and your reserves, and live on an island happily ever after. Or you can keep running the bank, and running the bank must be better. So that's on the right-hand side. That's the franchise value V of mu J, and that constrains collateral. It also means that how high the leverage can be is a very forward-looking constraint. If the franchise, and that shows up later on, if the franchise value of the bank declines for some reason because the future is bad, that means you can lever up less today. So it has an immediate impact, and that will show up in some of the impulse responses.
Sorry, the big question. What is big F?
Big F is the borrowing you do from the central bank, so funding from the central bank.
Okay, sorry.
Yeah. And then the afternoon. So this year's the Bianchi Biggio. That's maybe the less known portion, right? This Bianchi Biggio liquidity management. So they are the deposits of your bank of network type new and region J, and you must be prepared to pay off omega max times that. So omega max we calibrate to 0.1. You must be able to pay off 10% of the depositors on the spot. And you do this either with reserves, so that's the M nu J that you may hold, or with borrowing from other banks, at least for the unsecured, for the unconnected banks, right? That's the constraint that they have to worry about. The connected banks don't have to worry about it, because if the depositors come, they just borrow from their friends, and so they're not worried about that constraint. They can get the funding. It's the unconnected banks that have to respect this constraint. And you see, for the bonds, they can only pledge the bonds that they haven't already pledged to the central bank. So that's why there's this difference. The value of the bonds is QJ, so QJ is a market price for these bonds. And then they're only getting eta tilde on that. So if eta tilde, if haircuts rise, so the eta tilde collapses, that means they're getting very little for the bonds that they're holding. And that creates this portfolio problem. Okay, so that's the model. Then we calibrate it. Let me maybe not say much more to that. And let me remind you of the forces. So they're going to show up in these impulse responses, capital crowding out. That means if you buy more collateral, you can hold less capital. The banks have to make this choice between reserves and bonds. There's this spillover from south to north. As the south demands more collateral, that makes collateral also more expensive for the north. And then as the gap opens up between the haircut and the central bank to the private market, banks shift into a central bank funding.
And this,
so you see,
sorry, Harald, this sorry, Ada, T or without T, and
Right.
Ada tilde JT are backed out from
the data, yeah.
internally based on the pictures.
So yeah, so this is here
yeah.
the assumption. Actually, that's exactly
Okay.
the answer to this. So we looked at north and south were the same. So as far as the connectedness goes, right? So we just get the side. I mean, it's sort of a little jagged in the data, but that's a curve that we fit. I think it's an AR1 that we fit to this.
Could you say a little about the calibration in your previous slide?
Yeah. So some of them are. Let's see what you want to know. There's a longer slide, but I mean, many more parameters.
Well, I know, but just say a little bit of where these are coming from.
Yeah. So there's sort of high quality liquid assets, and based on that, we said the omega max is 10%. I mean, that's we had to come up with a number that did something in the paper, but 10%.
You got 5 assets.
5 assets, yeah. So right. Maybe 5, 6. I forgot that number of them. Right. And omega max is how many? What's a fraction of deposits that you have to be able to cover on the spot, in case all these depositors come on to withdraw? And we're saying the max of that is 10% of your deposit base is something that you have to come up with. And we looked at high quality liquid assets as a way of measuring, what banks would do.
Okay.
Kappa, that's maturity. So we want our bonds to be of 6 years maturity. In the presentation, I focused on 1-period bonds, but the bonds last a couple of years. This row is the inverse elasticity of the semi-elasticity of foreign bond demand, and we got that from a paper by Cochrane et al. The haircuts originally are set at 3%, so that explains why all these ADOTs are the same. The RF, that's the rate that we always keep constant. That's a central bank rate on, if you borrow from the central bank, you have to pay 0.2 to 5% per quarter or 1% per year. So that's very low. And 0.42 is observed share in 2007 of unconnected banks. And then there's some other parameters here. How much, what's the dividend share that you have to pay out? What's the Gertler, Kiyotaki, Lambda? What's the money demand parameter? What's government spending? What's average debt? Actually, it's known real, right? So that's why it's small. And we twist and turn these parameters until they match these.
So you have estimated all these?
Not estimated. I mean, estimation would be a glorious statement, right? I mean, we fiddled with them until it fit I guess it's a sort of, let's say it's estimation. You said we don't have standard errors.
Harold, the model is already super rich, but I guess one thing that's not directly in the model is the sort of housing market. And I was wondering the extent to which that was important in Europe over this period. I mean, the United States, subprime lending was obviously a big part of the 2008 financial crisis.
Yeah, I think
Spain as well.
Right.
Spain.
In Spain, particularly, the housing market collapsed, and there were these.
Because that could provide that could affect the impulse responses.
Right.
It could be a direct wealth channel through
credit. Right. I think in Europe they never had this mortgage-backed security crisis, though that was in the United States. I remember when that hit, the first banks that went under were actually German banks, because the German Landesbank invested heavily in those, and they had to be bailed out by the German government. But they weren't.
What does had to be?
Hmm?
I mean, the German government elected to.
Well, you could say that, but they were federally owned bank, really. I mean, technically, right? It's tricky. I mean, there's sort of public-private partnerships, perhaps. Anyway, so these mortgage-backed securities, they were never a big deal in Europe. All the mortgage lending is pretty much done by the banks directly, but certainly the Spanish housing market suffered greatly.
Now you'll tell us the results.
Yeah, exactly. So first the 4 facts, model versus data. So secured share, that's on the left. I mean, that's pretty much by assumption. We just say we match the data. Here's the central bank borrowing, and you can see that it's, it's going to spike. Both these shocks in there. So we have 2 shocks here. That's the other thing that I want to say. So we have this connection shock, and then a little later the haircut shock. So the haircut starts rising, or the eta tilde starts falling, quite a bit, after the disconnected happens. You see that, it's sort of constant first, and it's 3 years later, and that's going to matter to some degree. And that's where the yellow line is. That's where the haircut.
Right. Tell us what's going on here. So this is, I'm used to impulse response functions where you start at 0, there's a shock, and then something happens. That's not. This is something else.
So it's two. So in 2007, out of a sudden, and to the surprise of everybody, Xi is having the red evolution. Everybody understands in 2007 that Xi is no longer going to be constant, but that it's gradually dropping to much lower levels. So Xi is the fraction of banks that can borrow without having to post collateral.
It's like an exogenous. Is this an exogenous thing?
It's an exogenous event. So this is exogenous. Yeah, this is exogenous.
It used to be 0.42 until 2007.
Right.
And then you're feeding in, it's the red line.
Right, we're feeding in this red line.
Okay,
So
good.
the shock is learning that the red line is going to be, and you learn this in 2007.
Good.
And then 3 years later, actually in the data, it's 4 years later, and we kept it at 3 years anyways. 3 years later, so that will be 2010. They also learn that haircuts in the South will be dramatic, and will follow this red line, right? So it's constant until then. I mean, that's not quite true. Maybe, well, I don't know. Maybe it's true in the data, and then it falls off fairly rapidly. And we had these yellow dots on the blue line. That's really the data, right? And so the blue line is it's an artifact of putting a line through the yellow dots. And so the red line, we then tried to put I think it was an AR2 through that or something that explains that shape, but it's pretty much the blue line.
Haircuts, not
Private sector haircuts, yeah.
ECB haircuts or something.
They're constant, yeah. The ECB haircuts remain constant throughout.
It is the haircuts. Remind me what Psi was again.
Psi was the fraction of banks that could borrow without having to post collateral from the private sector. As far as the ECB is concerned, you always have to post collateral. And it's collapsing from 0.42 to 0.19 or so.
It is the number that chose to, not the number that couldn't.
So you have to post haircut. You have to post collateral if you're an unconnected bank. And Xi is a fraction of banks that don't have to post. They don't have to post collateral. They can be on the afternoon market. Their customers say, we want €1 million, and they just go to their friendly network neighbor bank and say, we need €1 million, and they ship it over.
Shocks.
These are the 2 shocks. Yeah, these are the stochastic. Yes, exactly. So the stochastic experiment. In 2007, everybody wakes up. They realize it's the red line, and in 2010, everybody additionally wakes up and says, "Oh my God!" Also, the private sector haircuts move, and they move in this particular shape that the model has.
Agents expect that they will continue past 2014, 2010. They anticipate the entire path forever after.
Yeah, they anticipate the entire path, and the haircuts are going to be permanently lower, for example, and the size is going to be permanently lower. So it approaches,
Okay.
I think 0.15 or 0.1, I can't quite read it here. Yeah, you could draw it out, but it goes to a lower limit in the end. So the steady state moves, right?
Exactly.
Yeah, right. The steady state moves. And okay, so that's the haircuts move. That's all. The third line is by assumption, and the deposit share. You get this, you get a little bit of movement. It's fairly constant, but you get this little, funky dip that you also see in the data. That's kind of the converse from the central bank borrowing. So that's just saying that the 4 observations that we had got matched. Okay.
So Athanasios has a question.
Sorry, Athanasios.
Let me figure out how to unmute. I need to figure out how to unmute you.
No,
you
you're
hear me?
muted. Yes.
Very good. Okay, so thank you. So Harald, this is really a fascinating model. I'm glad you're doing this, but I don't agree with the way you are modeling the baseline, because I was there in 2007 to 2011, which is the period you are modeling.
No, yeah.
It would have been wonderful if the ECB had maintained 3% haircuts. As a matter of fact, the experiment I think that would be worthwhile doing is the reverse. What we messed up in 2010 is that the ECB's framework started threatening countries, including Portugal and Italy that you have in the sample, that the haircut would rise to 100% if they were downgraded. And because of that threat, markets actually reacted, the spreads went up, and the whole thing unwound. So you really need to capture the threat of 100% haircut creating the crisis, instead of saying, oh, yeah, it was 3%, and it was so nice for stabilizing things. And you have the tools to do this. I think you have a wonderful model where you can actually ask the question, the euro crisis, which in my view was totally unnecessary, was 90% of that due to this peak-headed ECB policy, or 50%, or 60%, or 30%? I think you can quantitatively answer that question, but you're not doing that because your baseline is kind of way off.
Yeah, no, I mean, that's a great suggestion. And part of the problem is, of course, the private sector haircuts here are exogenous, right? So you are telling a story why the private sector haircuts endogenously respond to what the ECB does.
So because the problem is that the collateral policy can create multiple equilibria in debt markets. And by doing what we were doing, we effectively moved bond markets to bad equilibrium, and then everybody reacted to that. But that was a choice by the central bank. This is like the Fed telling us tomorrow that U.S. debt dynamics are unsustainable. So as of next week, they will no longer be accepting government debt as collateral. Think about that. That's the sort of thing that the ECB did.
I'm very sympathetic to that argument. I mean, it's a great argument. It's just that, I mean, it would require another extension of the model. In some ways, we have that actually, because our alternative policy has the ECB not accepting haircuts. So let me don't worry about the 51 slides. Half of them are just additional slides that are brought along. So I'm going to be actually getting close to the end here. So, okay. So this is now that
you should never put that number.
Yeah, I know, but yeah, it's my fault. Yeah, I'm going to end on slide 29 or something. So anyway, so this is the two shocks, the output movement here together. There's a sort of this funky, whiplash effect on output, and that has to do with this Gödel-Kiyotaki-Crowdy net worth forward-looking feature. I mean, anyways, it's let me not dwell on this, but you see this output drop that happens here once the haircut shock happens. Okay, so impulse responses. So remember, the Xi moves only very gradually, right? In 2007, the banks, everybody wakes up and says, gradually, the number of banks that can borrow without paying into collateral is falling. Nonetheless, you get immediately drop in output, and that's because of this forward-looking, the nature of the GKK constraint. Everybody realizes that the franchise value of banks has fallen, and that immediately dampens the investment that happens. So you get an immediate effect on capital markets and so forth, and that's what's shown here. But then, if you add also the eta tilde shock, and we saw this response in output. And it's driven, largely by the response in investment that also has this whiplash. The thing that I want to emphasize here on the slide is the two panels on the bottom, the capital in the south and the capital in the north. So when the haircut rises in the south, that makes collateral more expensive, and you see this in the collateral premium for the south, I mean, for the bonds, right? It makes it more expensive for them. And so naturally they invest less. You get this shifting out of this first force. You shift out of capital into posting collateral, but because the north and the south, they both compete for these reserves that the central bank is somewhat reluctant to put in here, if you like. The north doesn't counter that effect. The capital that the north holds doesn't rise, right? You would think that if the south invests less in capital, the north will now invest more in capital and just replace them. But the collateral premium has risen overall in the euro area, and that's this north-south spillover effect that happens here.
Can you tell the basic output story? So we demand more collateral from banks.
Right.
So they can't give you intraday money as much as they used to be able to. And now what happens? Somehow you invest less, or
Yeah, so the banks shift out of investing in capital into investing in bonds. So there's less investment
all the capital investment.
because the banks are holding all the
Banks own the
capital. So the banks have to hold their bonds, and so as a result, I mean, hold the balance sheet constant, right? There's so many things that can move, but if the balance sheet holds constant, and the only thing that happens is the mix between capital and bonds, as they have to hold more bonds for the afternoon, they have to hold less capital.
The people that they bought the bonds from,
Right.
why don't they end up? I mean, they're not allowed to hold capital. Well, what do they do? They just
Well, they're foreigners, right? So the
okay. So the
yeah,
rest
so
of the world
it could be a gift to the foreigners at that point, because that's true. The bond price, let's see, falls, rises, falls, right? So it's because the bond price rises here. So because banks are now willing to pay more for the bonds. I mean, it's a bit more complicated because the return to capital also
So
falls.
there's a cash.
Actually, the return to capital rises.
Come in the morning,
Pardon?
those are cash.
Right.
And those deposits used to go to buy investment goods, I guess. Or what happened to cash, but now the deposits go abroad to buy bonds.
Well, the deposits are always only held by households. So households hold deposits and money. So partly the banks compete against the money that the households have, right? So the central bank has issued a certain amount of reserves, and it's now needed by the banking sector because they need these reserves now in the afternoon to meet sudden withdrawals. And they're moving into that because bonds have become relatively expensive. So they're moving out of, I mean, they have to hold more collateral. That's one thing, but they're also shifting from bond collateral into money. So all these things are happening at the same time.
A classic fallacy is that banks are making paper investments, not real investments, so the economy is falling. Of course, my paper is
right.
Real investment. So I got to the classic fallacy, but I'm trying to tie up the general equilibrium of what people did with the money.
Yeah. So why?
Question. So I'll leave it there.
It's let me think. I mean, maybe the best answer is it's not just about windfalls. It's also about the net worth evolution, right? Given that in the future you have to hold more collateral and it's harder to borrow, the franchise value of banks have fallen. And that means the leverage constraint has become tighter. So it's not just you might get a windfall gain on the bonds, but nonetheless, the amount of leverage that you can have may become lower because the franchise value of the banking system has gone down. It's one of these weird forward-looking, Gertler, Kiyotaki
Can I
leverage
ask you,
constraint
I would have
features.
thought that deposits in the South and capital in the South, they would have mirrored each other, and they do up to. like,
Yeah, so
quarters
that's
or
right. So the deposits do this whiplash, and that's and again so capital falls, return on capital rises, and that means suddenly the network. So eventually, so the ADA here has this evolution, right? It also recovers after a while,
Oh, I'm sorry.
right? And so that means after the initial shock happens, but then after a little while, actually the future looks better than it just looked yesterday. And that means the forward-looking banks say, okay, now the franchise value for the banks goes up, so they can leverage up a little bit more, but they have to hold more collateral, so they can't invest in the capital.
But what I said is modulo the path of the whatever psi, I never know. these
Right,
letters.
yeah.
Okay.
And then you can compare the benchmark. I have to probably finish soon. Can compare the benchmark for the alternative. And really the main story is here that, in the alternative, you can't borrow from the central bank, right? And so if you look at the middle row all the way to the right, that's really where the difference is. The funding from the central bank, it's all now in real. That's why we use small letters. the funding from the central bank and the benchmark goes up, but in the alternative policy, that's sort of the Athanasios version, right? You can't borrow from the central bank at all, and because you can't borrow from the central bank, that worsens the the collateral situation. Collateral premium is higher because collateral premium is higher. Banks now can invest less. And you also see what happens with the capital. Capital actually goes down both in the south and north under the alternative policy because the spillover, north-south spillover is so strong.
So the chart up in the far left corner, up the top, is the same as the chart.
Yeah, that's the same. Yeah, that's the same chart here. And I used to have charts with all 93 responses, but I'm going to spell it out. So there's a lot more going on here and all the other variables, which is really what you have to look at to sort out. Is it the net worth? Is it paper gains? Or what's going on exactly? What's happening to the foreigners and so forth? So it's a lot going on. Anyways, so the summary here is interbank markets are important. I documented these 4 observations. Central banks, deal with these disruptions or these frictions or these movements on these financial markets. And so this model here was designed to deal with that. It's not about interest rate movements and inflation per se, but about these balance sheet policies and the haircuts. In this case, just a haircut that the central bank charges. And I agree, you could think about many of the other, there's a myriad of policies that the central banks introduced that are outside, standard, Taylor rule interest rate setting considerations. And I think models of that type, in principle, could help answer what they do.
So Harald, how would this compare to Giannakopoulos' collateral cycle?
Oh, I have to reread that paper. I read that a long time ago.
It's not an easy paper, absolutely. Okay, and something that's probably worth thinking about.
Yeah.
Because he has this endogeneity that has major real effects.
Yeah, right. Yeah. No, definitely. Well, thanks for pointing that out.
What do you come away from as an overall conclusion?
Well, that these policies by the central bank are really important, make a big difference for output, right? They're not just affecting
How do
health
we
of the
see
banking system.
How do we see that in your charts?
Well, that's this chart here, right? The alternative policy was benchmark policy. That the drop in output would have been twice as large. I mean, it's 0.5% is that large, right? It would have been a bit more than 1%. Plus, we get the feedback. I mean, if you do the discounted value, maybe they're the same here, even, right? If you look at that, which is kind of weird, but that's but it has to do with this Gertler-Kiyotaki karate dynamics of the leverage constraint and the return to capital. So, I mean, that's what it is. I mean, it surprised us too. Now, was it a good idea for the central bank to do what it did, right? I mean, that's a different question because we don't have, I mean, it's not welfare analysis. It's just saying this is quantitatively what we think it has happened and what would have happened if they hadn't done this. And Roger may be right.
What assumptions are you putting here that you're most concerned about? What assumptions are you most concerned?
Well, one is the flexible prices, that bites us because something happens to inflation here that's kind of weird. Let's just put it this way. And it's due to this Fisherian assumption and probably want to replace it with something else, but we didn't. And the other part is, the banks switching their status over the north-south, having that randomly switch every period, and also the connected, unconnected switching every period. That's not attractive. It would be nicer to really have the regions and have the hardwire the regions, but it just complicates the model even further.
Any other point?
Harald, if I could add on the takeaways. The main takeaway is this is something that no other country has done it. No other central bank has done it. So this paper is beautiful in that it gives us a model that can be used to explain the Euro crisis. It wasn't really about inflation monetary policy, and it was the collateral policy of the central bank that created the problem. And this is really unique to the Euro area. So this is beautifully done, but you need to do that experiment. Because it's like the actual policy was closer to 100% haircut. So it would have been wonderful if it was 3%.
Right. Yeah, no, I like that idea. I guess a model with cash actually sovereign default built in which the private sector haircuts are endogenous, right? Love to make them endogenous, but maybe by cutting down other parts of the model and reintroducing that, we could maybe go after that. Yeah,
Just
and this is also a very important lesson that was picked up during the pandemic when, following effectively the Fed's intervention to incorporate debt market, the ECB suspended its collateral framework. And this is why we didn't have any problems during the pandemic. They suspended the threat of cutting off collateral liquidity for 2 years.
So of course, there are different views in the Euro system of whether, what's good and what's bad there, but it's politically highly contentious. But I agree, it's important, right? And maybe that's what the paper points to, that, and one can look at the macro effects of doing that.
And just to amplify the point, the pattern of haircut that you treat as exogenous, that also, the turning point is also endogenous to policy.
Yeah, according to Athanasios,
that aligns with the bumblebee speech, whatever it takes, which is the ECB saying that they will provide liquidity.
Right.
They're going to provide liquidity either by buying the bonds or financing the bonds, etc. So it's not only in the origins of the crisis, but this, this other variable that's treated as exogenous is very much endogenous to the policy.
Right. Or you could say
a number of policies like that followed, because effectively, my reading of the history is that the ECB created a problem, and then it reduced the cost of the problem with the S&P, then with the OMT, with the Bumblebee. So those kind of efforts to contain the problem that was already created in 2010.
Yeah, I'm very sympathetic to that perspective. So, and you can see, when was the Draghi speech? Was it
2012?
Yeah, and you see this,
July,
you
August.
See this turning around here, right? I mean, you could potentially have 3 shocks here, right? You could have the Draghi speech shock built in, and that would be not a surprise. The private haircuts go back. I mean, I don't know.
Could you remind us of all which agents, government and non-government, are treated exogenously? Which ones aren't?
Yeah, all the government agents are treated as exogenous, so they're not optimizing. They're just
what do these impulse responses mean if you're freezing?
Well, it's
what do we get out of the
out of the experiment?
Well, the impulse response function. When you're freezing a first order important decision.
No,
or you think that monetary policy is not very important?
No. I mean, the haircut policy is very important, right? I mean, that's the point of this picture. I mean, I'd like to think of this as giving central bankers a menu. They can look at this and say scenarios. What happens if you do this? What happens if you do this? No.
But the other agents, government and otherwise, are assumed not to do anything, or is there some natural behavior of the other important agents? I'm confused.
I mean, there's fiscal policy that's also mechanical, so they have a certain rule for the evolution of the bonds. They have government spending, and then they have a certain debt policy. They want to return to certain debt to GDP ratio, essentially.
But these are in your impulse response functions, even though these are important, the impulse response functions assume the absence of any response of those agents.
Well, it's mechanical response, right? So the government, if they see that their debt is higher than where they wanted to be, they will raise taxes. I mean, they raise taxes in a very.
So I think we should have a private conversation. I think we should have a private conversation afterwards. Yeah.
But happy to.
Thank you.